A very warm welcome to all our viewers to the 35th edition of Cedrus Knowledge Series. We began the Cedrus Knowledge Series amidst the lockdown in the pandemic times with an objective of having one speaker each month speaking on a variety of topics ranging not just finance but also health and personal well being. We'll now play a short video of Cedrus Wealth Partners. For this series, I would once again like to welcome Mr. Sankaran Naren. He's the CIO and Executive Director of ICICI Pru AMC. He observes the entire investment function across the mutual fund and international advisory business. And with a rich experience of around 32 years, his views on the markets and the macros feature prominently across the media, both locally and globally. A very warm welcome, sir. It's an honor to once again have you with us. I think this is the third series where we have the privilege to interact and have your views. We'll now play a short video to further introduce Mr. Naren. For all our viewers, this is a moderated session where we will be asking our set of questions to Mr. Naren. And meanwhile, if you all have any questions, you all can post them in the comment section. We will take them towards the end of the discussion. Once again, a very warm welcome, sir, and looking forward for your views on the overall strategy on investments that one must observe during these times when we are witnessing global headwinds. I would now like to hand it over to Mr. Nilesh Bajaj for taking the discussion forward.
Thank you, Unnati, for the wonderful introduction. And good evening to all our viewers. And thank you, Naren, for again accepting our invitation for the third year of the Knowledge Series. You have always been a guiding force at Cedrus to actually understand the strategies which we need to adapt to, in the future with your views on different asset classes, in fact. In the introduction video, you must have seen one slide where we talked about superior risk-adjusted returns. And I think that is what Naren actually very candidly talks about different asset classes, that which asset class actually can have have better value in today's scenario, and where you have you can get a superior risk adjusted return. In fact, uh, uh, we will actually play a video of what he talked, what he guided us last year. We will quickly recap it through a video.
So, if you can predict what will happen to the Ukraine-Russia war and how crude oil will move from here, and that will help actually. Unfortunately, I don't think at ICICI we know what will happen to the Russia-Ukraine war, and that is an important thing actually. The gap in returns between equity and debt will be very low unless you have the resolution of the war. Whenever the war gets resolved, you will get a good return in equity temporarily. But after that, again, I feel that debt and equity will give you the same returns or not with much difference. Because in India, what happened was your investors actually bought when foreigners sold. And due to that, India fell much lesser than other countries. And therefore, Indian valuations today is much, much higher than every other country in the world. On the day the war started, who runs my long short fund, he told that the war will go on. Most of us have to forget that 2020 and 21 interest rates are not going to remain. And those people who have loans should be very, very conscious at this point of time. Find a way to repay the loans. That's my suggestion. If you are borrowed, it is not wise to believe that you got rates at very, very low levels. I think every borrowing is going to become costlier over the course of the next 6 months. And it is very important not to have borrowing, in my opinion, if you are an investor. If you look at it, the category was launched by us in 2004. And over the 18-year period that we have now seen, the category has done very, very well, with periods in between where it has not done well. Our view is simple, that as long as you're willing to be having a longer term outlook, I think the category will do well. And if you're going to continue to see an environment which is going to be volatile, I think we are going to have a good period. But if you're going to have an environment where you're going to have a very big bull market, then I think whatever be the theme of that bull market, I think that will do better than value. But we still believe that there is a fair amount of volatility ahead. And we could be wrong, but so what we believe has always been that as long as you're willing to invest for the next 3 to 5 years, value always appears and is a good category for investment. And that's been our 18-year experience. And we continue to like it. Right now, I'm in favor of dynamic bond all seasons kind of category at this point of time over equity savings. If you look at the returns in arbitrage funds, they are too low. So the arbitrage part of the equity savings is delivering too low a return. So that is giving me irritation at this point of time. So that's why any day I would say that a dynamic bond all seasons kind of category is what is most interesting. Because I believe that the next 5 years belongs to debt. And, if you look at your customer base, the quantum of money that would be invested in debt would be very, very low as a percentage of AUM. Somehow I'm very confident about that without knowing anything. I've not spoken to anyone. And without speaking to anyone, I have that view. So, I believe that, somehow I have to get people like Cedrus as customers to have a very big component of money in a dynamic bond, all seasons kind of category. In the last 10 years, one of the things which we popularized a lot was the balanced advantage kind of category. And that was the category which we popularized today, that every mutual fund has started the category. But maybe now people are more alive to risk. 1 year back, if you had told people that there's risk, people used to laugh at us. Today, people are alive to risk. Market is not cheap, but people are alive to risk at this point of time. That's the difference between 1 year and now. See, our view is that today, where is the difference between this year and June 2021? This year, people are more conscious of risk. Because people are more conscious of risk, what happens is things are safer. Last year in June 2021, people were not conscious of risk. Today, people are much, much more conscious of risk everywhere in the world. So I believe that markets are safer when people are more conscious of risk. That is the advantage at this point of time. There is some other problem in some other part of the economy which we are not recognizing, and that is the challenge at this point of time, which we also need to recognize, and that is where the problem is coming. Does it change the 5-year structural story? Answer is no. And the 5-year structural story is still good. But as I've been saying, I think in 2-3 months' time, debt is also going to be an interesting asset class. And therefore, you can play the structural story and you will get decent returns in debt also. It won't be like what it was in 2020 and 21. So you're going to get opportunities to play in debt, you're going to have opportunities to play in equity, and that's why you're going to have opportunities everywhere. And that is how we see it. But till crude oil comes down, I would not take that call that we are in a very, very big structural positive environment. And that is something I would still be more careful about at this point of time.
Then I think we've always been discussing about different asset classes and strategies we need to basically for the future, what the strategies for each asset class will be. In fact, we have seen a wonderful rally in the equity markets in the last 1 year. We have recovered from the lows of October 2021, where we saw the markets correct and markets recovered, and we are nearing the all-time highs. Uh, we have seen bond yields very sticky, but yields have also started cooling off in this year. So that is the second thing. Gold has been quite okay. The returns have not been great. They have been fairly the same as last year, except for the last 1 month where we have seen gold rise. So Naren, one quick question to you is, there is a lot of basically interest coming in equities, is from investors specifically, okay, and they are open to, actually, when we talk about equities, they are actually more open to take more risk, in fact. So the first question to you is, one, what do you citing that the Israel Hamas war, which is right now happening at our and because of which there can be geopolitical issues. Is this that same Russia Ukraine situation where we saw the markets did correct, but then we didn't see a deep correction, or this can actually have more repercussions for India and specifically Indian equities, in fact? So what would you comment on this?
Basically, what my view is that it's very tough to predict geopolitics and politics. And people believe that people from Bombay have knowledge of geopolitics and politics. We have no knowledge of either. And it's very impressive that all the other people believe that people from Bombay have knowledge of either, but they have knowledge of neither. But what we can tell you is that the domestic investor is in late cycle in equities. So what I mean by late cycle means they are taking very high risk. They are in, if you look at the SME IPOs, it is in almost bubble territory. They're very, very positive on small caps. That is again a sign of late cycle. Late cycle means they are taking excessive risk. And they are very, very positive on small caps. They are very, very positive on mid caps. They are very, very positive on derivatives. So I believe that the domestic investor in equities is in late cycle. And normally in late cycle, you tend to lose money or at least not make money in the medium term. The foreign investor, on the other hand, even in Indian equities, is in either in early cycle, mostly in early cycle, I would say. Because while they keep telling us India is a structural story, India is a great story, except in the period April to June 2023, there was one period. Barring that period, they have been negative on Indian equity for the last 2 years virtually. So I would say that they are in early cycle and the domestic investor is in late cycle. So what that means is that somewhere in the next 2 to 3 years, the foreign investor may invest in equity in a big way, which means that large cap is much safer than small and mid cap because they are not likely to go and put money in the smallest company in India. They are likely to put money in the largest company in India before investing in the smallest company in India. So I believe going forward over the next 2 to 3 years, large cap is much safer because the foreign investor is in early cycle. Why is the foreign investor in early cycle? You have to understand it is primarily because the foreign investors' interest rate suddenly zoomed from 0 to 5%. Whereas the domestic investors' interest rate moved up by just 1 to 1.5%. So the foreign investor completely had to desert equity market for debt market because they were getting zero for a long time in debt market. And now they are getting 5% for 2-year treasuries in US, for example. So they lost interest in equity market and said, let's invest in debt. So even though they like India, they are investing in debt. So at some point of time in the next 2 to 3 years, interest rates in the world will come down, and at that point of time, they'll come back to equity market, even in India, in a big way. So this is how we see things. So as far as politics and geopolitics is concerned, I don't think we know enough. But what is pretty clear is that the domestic investor is taking risk that they should not be taking. As we speak in October 2023, the inflows into small cap, the inflows into mid cap, the kind of derivative position which exists in stock futures, the kind of derivative position which exists in options is very high at this point of time, all driven by domestic investors. And why has that happened? This has happened because in the last 10 years, there has been hardly any big drawdown in domestic equities. And people have never lost money in domestic equities. So virtually they think that equities is a absolutely safe asset class. Tell that to a Chinese equity investor, tell that to a European equity investor, tell that to even a Japanese equity investor. They'll all tell you equities you can lose money. Try telling that to a domestic Indian investor that small caps is risky. They think you're a perma bad. So this is the challenge at this point of time. So this is how we think, but obviously what we say today is always unpopular in October 2023, and this is the challenge that we are having at this point of time.
No, I clearly remember in 2021, around June, we had our first interaction with you. And, like what you just mentioned, it was quite unpopular, in fact. It was quite unpopular then when you mentioned that Indian equities are in the overvalued zone, and you can actually see a kind of a correction. And we saw a decent correction, actually, in fact. Uh, you know, and what you really mentioned, and this is what I was going to ask, but you have also already answered, is, on the kind of interest which investors are actually, which we are seeing actually is on the mid and small cap space. And I think, the problem of rear view mirror approach of returns, where actually when investors are always chasing returns, which the other investors have already earned. So we keep telling investors that you need to look at returns in the future, not what other people have earned actually. And but I think very clearly you have mentioned that investors are always there is a greed and fear psychosis which is there, and we have never lost money in India. Investors have always earned a good amount of money, and I think that's so true actually that we are seeing even today a lot of inflows coming in mid and small cap space, in fact. But do you feel like what you just mentioned, that in case if there is a correction, if there is a correction, because we do have a lot of headwinds which you were just mentioning, interest rates are sticky, you have geopolitical issues which no one understands actually, and then you have the election which can lead to volatility in the future. But do you feel in case the markets correct, the mid and small cap is where actually the froth is more than the large caps?
See, what we have learned over the years is that if markets can go on, and you can have a bull market in small and mid cap which lasts a few more years. But the longer this bull market lasts, the longer will be the bear market. Now, whether when the correction will come, who knows? That no one knows. But the fact is that longer this bull market lasts, the longer will be the correction. So one
Good.
cannot predict whether this bull market in small and mid cap lasts for the next 6 months or the next 2 years or next 3 years. That no one can predict. Because see, one of the things I keep telling people is everyone believes SIP sahi hai. Now the fact is, imagine you have done SIP in Chinese equity for the last 10 years. Would you have made money in SIPs? So SIP sahi hai. You could have SIP in mid cap funds between 2006 and 2013. So, would you have made money in mid cap funds in between 2006 and 2013 in SIP Sahi model? And I found that in the knowledge series you had done one of my friends, Anand Tandon, and Anand and me are people from the 90s era. So I don't know what he told your people, but there are certain disadvantages of having spent 90s in the market, because we have seen bear markets also.
True.
So imagine if you had done, for example, if you had started investing in 94, 95, it took 2004 for the Nifty to reach where it was in 94. Not saying we are in that kind of situation. All I'm trying to say is that we have to recognize that there are risks certain times, and those risks are not always obvious. At least to me, I don't know about Anand, but I know that in 1994 I was not aware of all the risks in equity market. And so I believe that that is why I believe that in late cycle you have to be more careful. In 2021, large caps was also fully valued. Today, if you look at most of the mega caps from 2021 to 2023 have given no returns.
True. Yeah.
So that is the kind of situation we are in, and it is not. Remember, this is not a view that the market falls off tomorrow, because frankly, market in the near term is always a function of flows. Market in the long term is always a function of fundamentals. Markets can be overvalued longer. So there is a statement of John Maynard Keynes. He says that markets can be irrational longer than you can be solvent. And he went bankrupt a few times. And that is the reality going short. So I believe that you can't, there is no way I can tell you that the market is going to fall from tomorrow or Monday or something like that. But what I know is that to be rational, you have to do asset allocation. And today, if I tell people invest in hybrid, invest in large caps also, invest in flexi caps also, actually, no one wants to hear me.
No, that's not the case. At least we at Cedrus would always like to hear you. And in fact, we have taken a lot of learnings from you, in fact. Naren, in fact, my next question is, what we are doing is actually, I'm just asking you about different asset classes. And, very clearly, you have mentioned that, equity is in the overvalued zone, but it can be overvalued for long. So you cannot predict when the markets will correct, when the mid caps will correct, small caps correct. But definitely, as a valuation, it is in the overvalued zone right now. But that does not mean it will correct, right?
Exactly.
Yeah.
Exactly.
So my second question to you is, and this I remember, 2 years back you had told that, fixed income, the debt funds. Okay. It's a wonderful opportunity. The yields have gone up the roof. Okay. And, you are getting a great opportunity in the debt space. Uh, Now, two things have happened. One, the indexation benefit is gone on debt funds.
Yes.
Okay. So I think a lot of HNIs, ultra HNIs, institutions, corporates used to invest in debt funds for the indexation benefit actually, because it was a huge tax arbitrage which they were getting. Now that is something which is history for us. Uh, Two, we have seen just recently, that JP Morgan, India is going to get included in the JP Morgan bond index from June 2024. Okay. Uh, my question to you is: do you expect yields to correct? And bonds is a great, debt funds. How does an investor actually invest in debt funds in a scenario where now you don't get any tax arbitrage?
So actually, as you know, we have moved to a model where we have been recommending both multi-asset category and equity and debt category as
Hmm.
the best way to invest in debt at this point of time.
Hmm.
And because those are the two ways in which in multi-asset you of course get gold as well, gold and
Right.
exchange rate commodity derivatives as well.
Hmm.
And we have come to a conclusion that this is the best way for investors to consider debt in an indirect manner.
Hmm.
It's not that, see, if you look at debt also in global rates have gone up so much, India rates have gone up so little. So it is
Hmm.
not that debt is a thumping the table call at this point of time, which is the reason
Hmm.
why we think that it is better to invest in debt through these routes, through the hybrid route like equity savings,
Hmm.
equity and debt, balanced
Hmm.
advantage, and multi asset rather
Hmm.
than invest in a pure debt framework yet. That
Hmm.
is where we are at this point of time, and as you know, that is the way we have been thinking over the last 3 to 6 months. That is how we have been thinking, and that view hasn't changed for us.
Hmm. Okay. No, in fact, definitely, post the tax arbitrage, the indexation benefit going on debt funds, we've seen a lot of inflows coming in the equity savings fund. And you run a very conservative equity savings fund, which is got a very, the cap on equity is quite on the lower side. And we do get a benefit of taxation because of the the arbitrage which it has in the portfolio. But I was just asking about because of India getting included in the JP Morgan bond index, do you feel any idea that
Big yield drop, we don't believe, frankly.
right, right, right.
Because you have to remember the amount of debt that is issued against that
Hmm.
$25 billion is not so large that
Huh.
it will completely distort the entire curve. And government cannot, RBI cannot allow interest rates down to such an extent that
Hmm.
money starts flowing out of the country in some way. So,
Hmm.
we have a very, very responsible Reserve Bank and Finance Ministry.
Hmm.
Frankly, at any point of time in the last 3 years, the
Hmm.
Finance Ministry could have ensured that the bond inclusion happened. They
Hmm.
only needed to allow some taxation benefit, and it would have happened in a month.
Hmm.
uh,
Hmm.
the finance ministry and the Reserve Bank of India, because they are conservative, good institutions, they did
Hmm.
not give that benefit, frankly.
Hmm. Yeah.
And that's why today the investor who is investing is actually going to pay a lot of tax and a lot of problems for them when they
Hmm.
invest in Indian bonds. When the bond inclusion happens, they're going to
Right.
go through a lot of pain actually.
Hmm. 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 Hmm.
It is mainly because the government and the Reserve Bank actually have
Hmm.
carefully thought through this issue and said we don't want foreign debt money.
Hmm.
And I think it was a sensible decision on the part of the government.
Hmm. Hmm. Okay, no, wonderful. Actually, again, this is something which, you've given something which is beyond what we were thinking. That don't expect bond yields to fall just by inclusion in the JP Morgan index. And second thing is that the Indian yields have risen lower than the yields which you have seen in the other countries. So there's nothing where it's a thumping investment call on fixed income. In fact, now quickly on the third part is actually gold. Gold we have seen is resilient. It's always been that kind of an asset class. uh, with these kind of geopolitical issues which are happening, and specifically Israel and Hamas, I don't know how bad it'll go. No one knows, like what you mentioned. But do you feel that gold is better to be bought as a multi-asset, as a part of a multi-asset fund, or you should actually you can have a pure gold allocation in your portfolio? What would be a
I'm
better
of the
strategy
view
for
that
you?
it is either a sovereign gold bond allocation or a multi-asset allocation.
Right,
Uh,
right,
Either of them has to be considered. Of course, when you invest in sovereign gold bond, you have to be long term and you should not be short term. But these are
right.
the only two ways in which you should invest in gold, in my opinion. I think sovereign gold bond is the other way to invest, provided you have the time frame to keep the money for investment. Those are the two ways. Either invest through multi-asset or invest through sovereign gold. I'm not a believer at this point of time in gold ETF at this point.
Absolutely. No, wonderful. Actually, that's so true. At least you get a 2.5% coupon on a sovereign gold bond. And typically in India, gold people don't sell like real
Yes.
estate. They just hold on. So 7 years, 8 years is not a very long time frame for Indians, because they never liquidated gold. They liquidate everything. They liquidate equity at a wrong time, but not gold.
Yes.
uh, Now coming to multi-asset, I think this is one of the themes which we have also been actually advising investors, citing the way equity markets have rallied, the territory in which fixed income is. Gold. It's better to. We also feel that it's better to buy through a multi-asset strategy than individually buying it. Could you elaborate on whether this strategy at this point of time, your multi-asset has been ICICI multi-asset has been one of the oldest multi-asset funds in India. Okay. And I remember, I guess the return is given is almost equivalent to better than a large cap equity fund. So being a multi-asset where you have gold, REITs, fixed income, and equity, it is actually outperformed a large cap pure equity mutual fund. In fact, uh, what would you suggest, and what the strategy should be in the multi-asset space specifically?
I think SEBI rightly says past is not equal to future. So,
Right,
the past returns on this fund has made me very happy because I've been involved in this strategy for long.
right.
One of the things is that if you see the number of fund managers in the strategy, we have so many fund managers, and all of us are involved in the strategy because
Hmm.
this fund involves investing in REIT, InvIT, exchange traded commodity, derivatives, gold, debt, arbitrage, equity. And in equity also we can invest in large cap, mid cap, small cap. So we've got
Hmm.
so many areas to invest in, and
Hmm.
we made use of my guru James Montier says that if you want to invest for the long term, you have to invest in something unconstrained in a way. And if
Hmm.
you look at it, no, this is within the constraints of the fact that you have to invest certain amount of money in everything. This is one of
Hmm.
the most unconstrained funds in the market. And so
Hmm.
I like that whole strategy for the long term, someone who wants to invest money and keep it for the long term.
Hmm.
And that's one of the reasons, I have been a fund manager in this strategy and in its older avatar called Dynamic, because that also had a
Hmm.
lot of flexibility
Right.
primarily because of that reason. So, it's see something flexible is always less is good for the long term, because there are times
Hmm.
when some asset class becomes very cheap, and there
Hmm.
are times when some corners of the market become very cheap. Then
Hmm.
at different points of time, some corners of the market become very costly. and some corner of the asset class also becomes very costly. So we can make use of all the market imperfections over the course of the next 3 to 10 years. So it becomes a very interesting strategy. Having said that, I have also been amazed by the past performance of the strategy, that today I actually tell most investors that is unbelievable how the fund has outperformed almost all equity funds in the flexi cap strategy area also over the past. So that kind of worries me, that people should not think that everything that has happened in the past will happen in the future. But an unconstrained strategy has so many benefits that you will not realize unless you are a fund manager. That we are sitting on, like for example, if you see the monthly holding, there was a month where we made money out of crude because we are allowed exchange traded commodity derivatives. We could invest in crude and make money. You
Wonderful.
can't have any other fund in the market which can make money out of crude going up. So that is the advantage of this strategy.
No, and Naren very rightly said, actually, when we recommend an investor as an advisor, we always actually, the expectation on the risk and return, matrix of a multi-asset is lower than an equity fund, in fact.
Yeah.
But returns, it's given better than equity fund. And in fact, that is what one of our principles is, that, superior risk adjusted return. What is the risk you're taking to get that return? And I think, multi-asset strategy is one such strategy, which actually is specifically the ICICI multi-asset fund, which we have been investing, advising investors since since more than a decade now, and we have seen returns come, for investors. We have not taken out the money, uh, but do you feel these kind of strategies will put advisors like us out of jobs?
See, advisors are never out of jobs ever, in my opinion. But you need a little bit more volatility in the market.
Right.
You can't, you need at least Ukraine, you at least need Hamas. If you don't have Ukraine and Hamas also, and market goes up like 2021, then you are in deep trouble. Because end of the day, then even multi-asset is in trouble. Because in 2021 kind of market, people say, why do I need anything other than equity? Even gold will go down that year. So frankly, we need, for advisors not to go out of trouble job, they need some volatility. You need like last 3 days, market going down every day. You need periods like Ukraine. You need some events which cause volatility. If you don't have volatility, advisors will go out of trouble. There'll be times when even active fund managers will go out of trouble. So if you look at it, active fund managers have come back actually in the last 2 years. Otherwise, they were all, people were saying, you go passive, you go passive, you go passive.
Absolutely. Very true.
So today, if you look at it, suddenly, if you go and look at the alpha that created it is high. Maybe 3 years from now, it will be low or negative also. But right now, no one is saying active has delivered no alpha. No, everyone is saying, except in mid cap,
Right.
many of the strategies alpha has been created actually.
Absolutely. No, that's so true. Actually, the alpha is actually created by active fund managers. I remember there was a time when there was a lot of debate. In
Yes.
fact, we also in the knowledge series in 2020 had talked about it with one of our guests. That do you feel that the passive strategy is something which is here to be, and are active fund managers out of business because they were actually underperforming the indices, and last 3 years we have seen actually they have done much better than the benchmarks. In fact, Naren, you have two multi-asset strategies in the. This is specific to your strategy in ICICI now. You have one is a pure the old ICICI multi-asset fund, and one is the passive multi-asset global multi-asset fund. Could you just elaborate in brief as to
Then the
what
other
are
one
these?
is invested only in ETFs, and currently
Right,
it has taxation which is equal to debt. So that
right,
makes it less
mm,
attractive
right.
at this point of time. Whereas the equity, the
Mm,
ICICI Prudential multi-asset fund is the one which we are now focused on at this point.
true, true. Absolutely. Naren, closing remarks before we get into the festive season for all our investors, And one sentence of guidance you will give our investors for the for this Samavat, for the for the 20 for this year actually.
There are times I tell investors, if you have made too much money, book profits and enjoy it. Take a good holiday, spend money, revive the economy. So that's one I say. The second, I say that the biggest mistakes are made in big bull markets.
Hmm.
So do not get too greedy now. Live life peacefully, enjoy. Do not try to become too greedy now. This is not the time to become very greedy. This is the time to enjoy. This is not the time to be greedy. That is what I would tell all Cedrus customers to be: enjoy, not be greedy.
No, wonderful. Uh, Thank you very much, Naren. In fact, it's always a pleasure talking to you, and we very seriously take your advice, actually. So, we very closely, listen to you and see to it that we advise our investors, because I think, our value system has also been that we don't want investors to lose money by taking too much risk. It's better, have that Buddha moment for the investor where he's at peace. Okay, than to just try to run behind returns, in fact. And it's been wonderful talking to you
So
today as
enjoy
well.
the festive season. All best wishes for festive season. Thank you.
Yeah, thank you very much, and same to your family too,
Thank you.
from everyone at Cedrus. Yeah, yes, sir.
That was indeed a wonderful session, sir. I think your views has given us a lot of key takeaways for us and our investors, and as always, a differential perspective. I'll just ask a few relevant questions from the audience. My first question to you is that, except crude, which other industries will get impacted because of the Israel-Hamas war?
No, clearly, I would say that sectors like airline industry could get affected if things go on, and I mean, if you look at oil marketing companies in the period in the next 6 months could get affected. We take the long term, as contrarians, we will use this opportunity in a contrarian way rather than we are not day traders, so we will use this opportunity in a contrarian way. So what gets affected may be the ones we will buy rather than the ones we will sell at this point of time. If you're a day trader, maybe you'll have to do something different, but as mutual fund investor, we could do something opposite.
Right, sir. And my next question is that, with the high interest rate, will this impact the expansion plan of many companies? And how will this impact the NPA? Will this have any impact on the NPA in the near term?
No, clearly, I think it is already having an impact. If you see the foreign investors, they are not coming in a big way at this point of time, and a lot of private equity people are actually selling stock in India. And I think the domestic interest rates haven't gone up much. So I think if domestic interest rates go up a little bit more, then if they go up by 1% or so, it will have a negative impact. But Indian interest rates is one of the few countries in the world where interest rates haven't gone up significantly. That's why there has been little negative impact actually.
Right, sir. Uh, that was it from my side, sir. Thank you so much for making the time to grace this event and for all your inputs. It's a very valuable takeaway for all of us. On behalf of Cedrus Wealth Partners, I would like to thank you, Naren sir, and the team of ICICI, and also to all our viewers for tuning in and making the Knowledge Series a success as always. We will
Thank you.
return next month. Thank you, sir. We'll return
Happy.
next month again.
Thank you.
Thank you, sir.
Okay, thank you, Naren, and
Thank you.
have a wonderful weekend.
Thank you.
Yeah, take care. Take care. Thanks a lot.